Broadcast is now starting. All attendees are in listen-only mode.
Hi, good morning, everybody. Thank you so much for joining us today. This is our November webinar on charitable planning or charitable donations. And for those of you who are joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth. I've been with SEM for about 4.5 years now, and my primary role includes client service, marketing, and compliance. I just want to start off with a few housekeeping items for you. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be personally monitoring all of them and will ask David to answer as many as time allows at the end of the webinar. If we do happen to run low on time, David or myself will reach out to you directly after the webinar to make sure we do get your question answered. Now I'd like to introduce our speaker for today. David joined our firm back in 2016 as a senior financial advisor. He brings with him over 20 years of experience in financial planning and wealth management. And prior to joining our firm, David most recently spent 10 years at Commonwealth Financial Network, assisting over 1,500 advisors nationwide with complex financial planning solutions and building comprehensive wealth management plans for clients. He continues to bring his expertise to our firm by conducting portfolio reviews with our clients, co-managing client portfolios, and building, analyzing, and maintaining comprehensive financial plans. He also serves as a member on our firm's investment committee. David, thank you so much for joining us today.
Thank you, and welcome everybody. Good morning, and thank you for joining us for this month's webinar on charitable planning. This is the time of year when folks start to think about charitable planning. Many people give throughout the year. Some people will start to organize their tax planning around this time of year and think about charitable donations as we get to year end. So we're excited to cover this topic today. We discuss charitable planning with many of our clients, and it's a good topic to discuss for financial advisors and clients because it's important to really keep an eye on charitable planning in light of one's overall financial plan and, of course, with an eye on tax planning as well. So we'll cover several items today related to important aspects of charitable planning, and there will be some items that we'll just kind of touch on and mention, but not get into as much detail. We do have a white paper posted on our website, which is stonehearthcapital.com, where we get into some further detail on some of the items that we might touch on in today's webinar. So I'd like to go over some of the items that we'll discuss today. As I mentioned, there is a impact for tax benefits as it relates to charitable giving. So we'll talk about those tax benefits, and we will discuss the impact of the new tax laws. I still call them new tax laws. We're a couple years into it now, but the changes that came into play with the new tax laws had an impact on charitable planning. So we'll talk about the impacts and ways to work around that. We'll also discuss some different options for charitable giving beyond just making an outright donation. There are some more sophisticated ways for charitable planning, so we'll get into those today, and one of those would be donor advised funds. So we'll talk about how those work, and we'll also talk about the use of trusts for charitable planning as well. And becoming more popular these days, we'll talk about qualified charitable distributions, which are charitable donations that you can make from your IRA. So we'll talk about how those work and some of the rules around those types of donations. The word charity actually comes from a Latin word, caritas, meaning loving kindness through giving. And really a gift to charity is just simply a gratuitous transfer of property to a charitable organization. And the key is that your gift must be some kind of property. Your time or personal services don't count. There's several different types of property that can be donated to charity, and a gift is really limited only by what you have or what you want to give to charity. The decision to donate to charity is really a personal one. So although the IRS does not require that you have any charitable motivation or intent when you donate to charity. You can do so strictly for the tax benefits, but most people who decide to donate to charity have some charitable intent. So important to understand what that level of intent is and develop a charitable plan around how you want to give. I want to spend a couple of minutes just talking about record-keeping requirements that are in place for charitable giving. So through tax laws, Congress has attempted to encourage charitable giving because it's good social policy. So most every charity depends on individual contributions to remain financially solvent, especially in this era of fewer direct government dollars. And as a result, charitable giving has become really interconnected with the tax laws, which have grown more and more complex. So just important to be aware of certain tax laws. So as it relates to the record-keeping requirements, to support charitable tax deductions, the IRS has developed these record-keeping requirements for the donor and additional substantiation requirements. So a donor really should try to retain records for any contribution made to charity for which they want to get a tax deduction for. So whether that be a canceled check or a bank statement that displays the name of the charity or a dated receipt. So, for cash contributions, if you're giving less than $250 in cash, you'd want to have a bank record or written acknowledgement from the charity. If you're giving a cash contribution of more than $250, you'd want to have both, the bank record and a written acknowledgement from the charity. For non-cash contributions, if you're giving property valued at less than $250, you just want to have a written receipt with a description of the property that you gave. And if you're giving property valued at more than $250, you'd want to have a written acknowledgement with the property description. And sometimes that can come from the charity, or it can be a receipt that the charity provides, and you can have the written description on there. For non-cash contribution requirements that are more than $500 up to $5,000, again, you want to have that written acknowledgement from the charity, and in this case, you'd be filing a form with your taxes, and that would be the IRS Form 8283. Now, if you're going above $5,000 and up to $500,000, you'd want to, again, have that written acknowledgement with the IRS Form 8283. But in this case, you're also going to be looking to have a qualified appraisal attached to the tax return, unless it's a marketable security, in which case the appraisal is not needed because the security would have a value that was attached to it. So a donor can generally take an immediate income tax deduction for contributions of money or property to a charity if the donor itemizes deductions on their federal income tax return. The amount of the deduction really depends on several factors, including the amount of the contribution, the type of property donated, and the donor's adjusted gross income. So generally, deductions are limited to 50% of the donor's adjusted gross income. And now the Tax Cut and Job Act of 2017, which I referred to initially as the new tax laws, that added a new category for cash contributions to public charities, which allow a taxpayer to deduct cash contributions to a public charity up to 60% of their AGI. So that's a new category with the Tax Cut and Jobs Act. And that act that came into effect in 2018, those new tax laws will be in effect until 2025, unless Congress acts before then to either extend or change the tax laws. So when giving cash to public charities, you can donate an amount, or you can take a deduction for an amount up to 60% of your adjusted gross income. A lot of people don't end up bumping into these deduction limits because they represent a larger amount of a charitable donation, but certainly good to be aware of what these limits are for your donations and tax planning. So In addition to these overall limits, there are additional limits based on the type of charity a donor contributes to, as well as the type of property that's contributed. So let's take a look at these additional limits. The type of charity and the type of property. This is where charitable planning becomes very interesting and can be a little bit more complicated. But as I said, some people don't really bump into these limits, but it's important to be aware of them. So as I mentioned, if a donor gives cash to a public charity, the donor's income tax limit is 60% of their AGI, their adjusted gross income. Now, if the taxpayer contributes non-cash property to a public charity, that limit drops to 50%. Now, in contrast, if cash is given to a private foundation, this limits the deduction to 30% of adjusted gross income. If a donor makes a gift of long-term capital gain property, such as appreciated stock that's been held for longer than 1 year, the deduction is limited to 30% of the donor's AGI. And usually it's the fair market value of the property on the date of the donation is used to determine the amount of the charitable deduction. So in other words, would be the fair market value of the securities that were donated on the date that the donation was made. However, on long-term capital gain property, if the gift is made to a private charity, the gift is limited to 20% of adjusted gross income. So just important to be aware of these different limits because it's going to impact how much you can deduct in a given year. So those were a lot of different facts and figures. Let's take a look at an example of how this would work. Let's say that John has adjusted gross income of $80,000 in a particular year. So if John decides to give $30,000 of cash to his college, how much can he deduct? Remember, this would be a cash contribution to a qualified charity. So in this case, he can deduct the entire $30,000 because in this case, since it was a cash contribution, he could actually deduct up to 60% of his AGI. So in this case, he could have gone all the way up to $48,000. But he contributes 30, he can deduct the 30,000. However, let's say if he gives $30,000 of cash to a private foundation, how much could he deduct in that case? Well, the deduction limits are different in this case, so he would only be able to deduct $24,000 because he donated to a private foundation that is limited to 30% of his AGI. So that deduction would be limited to $24,000. So you might say, well, what happens to that additional $6,000 that he donated but he wasn't able to take a deduction for? Well, the nice thing is the IRS allows something called a charitable deduction carry forward. So what happens if you can't use your entire charitable deduction in 1 year? Well, the IRS is kind enough to allow us to carry forward any unused deductions for 5 additional tax years beyond the year that you donated. So important to note, though, that in those subsequent years, you deduct first any contributions you made to charity in those years before you can use a carry forward. So if you continue to contribute to charities and you're always bumping up against those limits, it may be that you can't use those carry forwards because they're calculated after any deductions in a given year. But the nice thing is if you do have any unused charitable deductions, you can carry those forward for up to 5 years. So let's shift gears a little bit and talk about some additional charitable planning strategies. To this point, we've really identified what would happen with making outright gifts of cash and property to charities. Think of that as just making a one-time donation of gifts, of cash or different types of property to charity. That would be done during one's lifetime and is commonly done year after year. But there's other types of planning strategies that we'll spend some time talking about here today. That could be a bequest, which would be a situation where you're making a charitable donation through your will or some other type of trust. There also are donor advised funds, and then there are different types of split interest gifts that are done through the use of some more complex trust planning. So we'll discuss charitable remainder trust and charitable lead trust. And then again, as I mentioned before, we'll get into talking about qualified charitable donations. So with a charitable bequest, it's really a gift left to a charity after the donor's death. The easiest and most direct way to do a charitable bequest is by an outright bequest of cash in your will. So making an outright bequest requires only a short paragraph in your will that names the charitable beneficiary and states the amount of your gift. And the outright bequest is especially appropriate when the amount of your gift is relatively small, or when you want the funds to go to a charity without any strings attached. So you're not really worried about the timing of it. You're just happy to have that bequest go to the charity through your will. So donors can really make a bequest by means of a will or a revocable trust or beneficiary designation on accounts or life insurance policies. So it is in many ways similar to an immediate gift, except that it occurs at a future date, which would be the death of the donor. So as a result, the donor has full use of the gift during their lifetime, and so the donor does not receive an income tax deduction at the time that the bequest is documented. So at the time that you might document that in a will or document a charity as a beneficiary of a financial account or life insurance policy, you're not taking a deduction at the time that you do that, but the estate can claim a deduction for the full amount of the bequest from the estate tax return. So it's just an important distinction of the timing of when a tax deduction can be taken. Next, I want to spend a little bit of time talking about donor advised funds. A donor advised fund offers a really easy way for a donor to make a more significant charitable gift over a longer period of time. And a donor advised fund is similar to a private foundation, but requires less money to set up this type of a fund. It also really requires less time and legal help as well. And the administration to establish and maintain a donor advised fund is also a little bit easier than a private foundation as well. A donor can generally take an immediate income tax deduction for contributions of money or property to a donor advised fund if the donor itemizes deductions on their federal income tax return. And the amount of the deduction depends on several of the factors that we've already covered here, including the amount of the contribution and the type of property donated and what the donor adjusted gross income is. So a few slides ago, we talked about the type of property and the limits on the percentage of your AGI. So all of those would come into play when making donations to a donor advised fund. So it's easy to establish the donor advised fund account. And the way that it works is a donor would first establish an account with a donor advised fund company. That company itself is considered the charitable entity. So when you make that contribution into the donor advised fund, it's considered to be a donation at that time. And then after the fund is set up, the donor just simply makes contributions of assets, which may include cash or marketable securities and other types of assets, depending on the fund. And the required minimum contributions vary from fund to fund, but are usually less than what you would see that you would need to donate to a private foundation. And then what happens is during the life of the donor, they can make ongoing recommendations to the fund as to how much and when and to which charities the grants from the fund should be made. So the donor may also suggest that upon death, the grants are made to charities named in his or her will or other legal instruments such as a revocable living trust, or the donor may designate a surviving family member to recommend grants. However, the fund is not obligated to follow any of the donor's suggestions, hence the term donor advised fund. But as a practical matter, though, the fund will generally follow a donor's wishes. So you can see on the slide here, generally the way that the donor advised fund works is the individual donor makes contributions to the donor advised fund, and as I mentioned, that's usually a separate entity that actually will own and operate the fund. And through that fund, the donor can just simply make recommendations to the charity or charities that they want the donor advised fund to make donations to, and of certain amounts that they want to go to those charities. So donor advised funds can be a good vehicle to use if you're getting close to year end and you haven't really decided which charities you want to give to, or how much you want different charities to get, but you have a good idea that of the dollar amount that you want to donate. So maybe getting close to year end, you're not sure of all the charities you want to give to, but you can establish, for example, a $5,000 or $10,000 donor advised fund, and after the fund is established, then you can direct that fund to make gifts to charities. And even if those happen in subsequent years, you can take the tax deduction in the year that you set up the donor advised fund. So in many ways, that's where a lot of people will use the donor advised fund when they have more than a small amount that they want to give, but they haven't fully scoped out the level of their charitable planning. So it's easy enough to just set up the donor advised fund and then make the recommendations thereafter of the amounts that will go to the various charities. Another type of more sophisticated planning other than donor advised funds would be charitable giving with trusts. And in this case, there are a couple of different trusts that are set up that have received blessings from the IRS to receive favorable treatment in terms of the timing of a tax deduction based on the way these trusts are set up, even though the actual named charity might be receiving the donation at a later date. So we'll spend a few minutes talking about these two types of trust. The first is a charitable remainder trust, and this type of trust is a irrevocable trust, and it's used to enable donors to give money or property to charities while continuing to receive income from the property for the life of the donor or for a period of time up to 20 years. So in this case, the donor, which would be referred to as the grantor in this case, and or their beneficiaries, which could be family members or themselves, they're known as the income beneficiaries, they would receive distributions from the trust annually, and then the charity would be the remainder beneficiaries. The charity would receive the assets remaining in the trust when the trust ends. So the donor first makes a contribution of money to the trust. The donor and or their family members can receive income from that property put into the trust for the donor's lifetime or up to 20 years. And then after that time expires, the remaining property that's left in the trust would then go to the charity that was named in the trust. The nice thing is, as I mentioned, with this type of trust, the grantor, the donor, can get an immediate tax deduction for that remainder interest that's going to go to the charity at a later date. They can also defer or avoid capital gains tax on the donated assets if they've contributed highly appreciated stock to the trust, and they can get a gift or estate tax deduction for that remainder interest if that ends up happening at the end of the life of the donor. So the age of the income beneficiaries or the fixed term of years will come into play when determining what the remainder interest is that's going to go to the charity, which will then drive what the income tax deduction is for the donor. And there are other factors that are used to determine that as well. The IRS will publish certain rates that are used to figure out what that remainder interest is that's going to go to a charity. So again, the charity might not be receiving the donation through this trust for many, many years, but you're able to calculate what the present interest value is on that future amount going to charity, and then you can simply take a deduction in the current year when you set the trust up and you fund it. So they're slightly more complex method of donating to charity, but they can certainly be useful for situations where someone wants to contribute larger amounts to charity, and especially if it's situations where it's low cost basis stock and the highly appreciated stock is donated into the trust, and the family simply wants to receive some income back from those assets, but have the remainder go to the charity. Graphically, this is the way that it would work. As I mentioned, the first step is the donor establishes the trust, and they fund the trust with certain property, and then the trust will use those assets that were contributed to the trust to have income go out to the donor or the family, and then, as I mentioned, at the end of that donor's life or a term of years, up to 20 years, the remainder would go to the charity. So this can be suitable in situations where maybe an individual may not have children or may not have ultimate beneficiaries that they want to give to, so they're allowing this income stream to come to themselves for their life, and then at the end of their life, this remainder interest can go to charity. And also, as I mentioned, it can be appropriate in situations where individuals have highly appreciated assets, or assets that may cost money to maintain, such as land, for example. Another type of split interest type of trust that's used in charitable planning is a charitable lead trust. And a charitable lead trust is essentially a reverse of a charitable remainder trust. So in this case, with a charitable lead trust, the charity receives the income stream when the trust is set up. Then at the end of the specified term of the trust, which can be a term of years or for the lifetime of the donor, the remaining income and principal in the charitable lead trust can either revert back to the donor or pass to other non-charitable beneficiaries in the trust. So it's exactly the opposite of what we saw with the charitable remainder trust. With the charitable lead trust, when the trust is first set up, the charity receives those regular payments for a term of years, and then the remaining assets will go to the donor or their heirs, depending on when they want that to occur. So in this case, the trust is irrevocable. When these types of trusts are set up, they're irrevocable, although with a charitable remainder trust, you are able to change the charity, but you're just not able to revoke the terms of the trust. So similarly, when we saw the graph with the charitable remainder trust, the charitable lead trust is similar, but again, just a little bit different on who is getting the income and who's getting the remainder interest. So with the charitable lead trust, the charity is the entity that will get the income, and that will occur first after the trust is set up, and then the balance at the end of that term will go to either the donor or their family at the end of that term. So the charitable lead trust, sometimes referred to as a CLT, can be funded in a couple of different ways. It can be a inter vivos trust, which means that it's funded during the grantor's life, or it can be a testamentary charitable lead trust, which is funded at the donor's death through the donor's will. So as long as the CLT is included in the donor's taxable estate, the estate can deduct the net present value of the income stream going to the charity. So just as with the charitable remainder trust, with the charitable lead trust, the donor can take an immediate tax deduction. So in either case, the deduction is based on calculating what that present value interest is of the amount that will be going to charities. Moving over to another type of charitable planning technique is a charitable planning strategy that's become a little bit more popular over the last couple of years, and it's known as Qualified Charitable Distributions, or QCDs. And these first came about with the Pension Protection Act of 2006, first allowed taxpayers that were over 70 and a half to make tax-free charitable donations directly from their IRAs. And by making a qualified charitable distribution from an IRA directly to a qualified charitable organization, these IRA owners were allowed to exclude up to $100,000 annually from gross income. So these gifts would otherwise be taxable IRA distributions. So the advantage is you're able to avoid the tax on that distribution you would have received from your IRA by directing it to go directly to a charity instead of to you. So the law was originally scheduled to expire back in 2007, but it was extended periodically through about 2014, and then subsequent legislation finally made it permanent in 2015. So how do these QCDs work? Well, you must be 70 and a half or older in order to be eligible to make a qualified charitable distribution. And as I said, you just simply request to make a distribution directly from your IRA, other than a SEP or simple IRA, but directly from your IRA to a qualified charity. And the distribution must be one that would otherwise have been taxable to you if you received it. So as I mentioned, you can exclude up to $100,000 a year of QCDs from your gross income. And if you file a joint return, your spouse, if they're 70 and a half or older, can also exclude another additional $100,000 of QCDs. But note that if you don't get to deduct QCDs, you don't get to deduct them as a charitable deduction on your federal income tax return. That would be double dipping. So you're not taking the charitable deduction, as I talked about earlier, but you're able to exclude it from your income. So the QCDs are good because they do count towards satisfying any required minimum distributions that you would otherwise have to receive from your IRA, just as if you had received an actual distribution from the plan. However, the distributions you actually receive from your IRA, including any RMDs, and then subsequently transfer to a charity, do not count as a QCD. So the important point is it has to go directly from your IRA to the charity. You can't take the money out of your IRA and then receive it and then donate it to charity. That would just simply be a regular charitable donation. So due to the new tax laws, many people are not itemizing deductions and therefore aren't able to deduct charitable contributions as much as they used to. So a QCD is another option to work around this. So since you're not taking a charitable deduction with a QCD, you're still able to donate to charity and reduce taxable income while satisfying your RMD. So in many cases, people have looked to QCDs as a nice option if they're now taking the standard deduction instead of itemizing deductions, and therefore not being able to take charitable tax deductions. They've kind of shifted their thinking over to using QCDs for those that are old enough to do so as a way to minimize the taxable income they have to report while satisfying their RMD and still being able to donate to charity. So QCDs are a nice option to look at if you've got some RMD money coming out of your IRA that you may not otherwise need. As I talked about, the new tax legislation has impacted the way that charitable tax deductions are working. So we'll spend a little bit of time talking about some ways that you can work around that. So as I mentioned, the Tax Cut and Jobs Act, which was passed on December 22nd of 2017, it created some new rules to consider when you're planning and determining the tax benefits of charitable contributions. So tax deductions for charitable contributions require you to itemize your deductions on Schedule A of your tax return. And itemizing deductions on a tax return makes sense when your total deductions from itemizing will exceed the standard deduction that's offered to all taxpayers. So you either take the standard deduction or you itemize on Schedule A. So what happened with this Tax Cut and Jobs Act, it included two changes that impacted the amount of people who benefit from itemizing tax deductions. So first, the standard deduction was increased, and secondly, the new tax law put a cap on the amount of state and local income tax that can be deducted. So the new tax law nearly doubled the standard deduction from $12,700 in 2017 to $24,400 this year in 2019. That's for married couples filing jointly. And for single filers, it took the standard deduction from $6,350 in 2017 and increased it all the way to $12,200 in 2019. So the cap on the deductible amount of state and local income taxes has really decreased the amount of itemized deductions really for millions of taxpayers, so making it more advantageous for many people to just simply use the increased standard deduction when filing their taxes. So given that charitable contribution deductions are part of a taxpayer's itemized deductions, if more and more people are taking the standard deduction instead, the tax benefits of charitable donations are lost for many people. So one way to work around this change is to employ a strategy referred to as bunching for charitable donations. And this really refers to a method where you would give multiple years worth of charitable donations in 1 year, so as to increase your itemized deductions in that year above the standard deduction amount. And then in the other years, you would not make a charitable contribution and then take the standard deduction instead. So donor advised funds, as were previously discussed, are a nice way to work with this bunching strategy. So let's look at an example to illustrate this strategy of bunching charitable donations. Let's say that Joe and Lisa are a married couple. They file jointly and they have $100,000 of income, and they have $20,000 of itemized deductions before any charitable donations. And the couple plans to make $6,000 of annual charitable contributions in both 2019 and 2020. So by making a $6,000 donation in each of those two years, and itemizing in both years, that would yield $52,000 of combined tax deductions over the 2 years. So it would be $26,000 of deductions in each year. And since $26,000 of deductions is higher than the standard deduction, then they would be able to itemize. So their charitable donations are enough to get them over the standard deduction. They itemize in both years. It seems like a pretty good deal. They'll get $26,000 of deductions in each year. So if you look at the 2 tax years, it's $52,000 of deductions, which is pretty good as a way to work with the new rules and still be able to itemize their deductions. But let's say the couple decides to bunch $12,000 worth of charitable contributions into 2019, and then took the $24,400 standard deduction in 2020. So instead of using $6,000 of donations in 2019 and 2020, they just simply look at it and say, okay, we were going to donate $12,000 over the 2 years. Let's just donate all $12,000 of that in 2019. So in 2019, they end up doing a Schedule A and itemizing their deductions again. And remember, they had $20,000 of deductions already before their charitable contributions. So by bunching the 2 years of charitable contributions into 2019, now they have $32,000 in itemized deductions. Then in 2020, they take the standard deduction, which would be $24,400 in deductions, and they don't have any charitable contributions on top of that. So now with this bunching technique, you have $56,400 of combined tax deductions over the 2 years. as compared to the 52,000 of combined tax deductions that we would have had without the bunching technique. So essentially, you've got 4,400 more in tax deductions. You've still given the same dollar amount to the charities over those 2 years, but you've been able to just effectively work within the new tax laws and come up with $4,400 more of tax deductions. So bunching can be a nice technique to be able to do this. And as I mentioned, it could be just outright donations to charities. In this case, that $12,000 in 2019 could have been contributed to a donor advised fund, which would have given them the ability to take that donation in 2019 and then simply make recommendations for that donor advised fund to actually contribute to the charities in a subsequent year. So the bunching technique has become more of a popular way to just work around what the Tax Cuts and Jobs Act has done to the comparison of standard and itemized deductions. Some other charitable planning strategies that are a little bit more complex, we won't really get into in detail today, but as I mentioned, I do cover some of these in the white paper article that was written on this topic that is up on our website, stonehearthcapital.com. And the other techniques are private foundations, which will generally be used in situations where a donor has a large sum of money that they want to donate to various charities, and they're going to set up a foundation in order to do this. And in this case, you're looking at situations of several $100,000 or more that will be donated to charities to have the private foundation make sense. There's also things called pooled income funds and annuities that are charitable gift annuity types that will help donors give to charities, as well as something that's simply called a bargain sale, which is just simply a situation where you agree to sell something to a charity for far less than it's worth, and you can take a deduction for the difference. So maybe you're agreeing to sell a piece of land that's worth $100,000, and you're selling it to a charity for $50,000. So you're giving them a bargain sale, and you can take a tax deduction on the difference between what you sold it for and what the fair market value of that item is that you're donating to charity. So there are other strategies that can be employed for charitable giving as well, and important to discuss these different planning strategies with your advisors to kind of see which one will fit best with your situation. Couple of concluding thoughts here as we wrap up. We've seen many different types of strategies here that can be employed for charitable giving. So for many people, charitable giving is just as simple as writing a check or making a credit card donation to their charities, or maybe setting up annual donations that you make to your favorite charities. But for many folks, there are benefits to employing some of the more complex strategies that we talked about today. So it's important to be aware of these different strategies and think about which one of those strategies might fit for the situation for you and your family related to your charitable giving goals. So it can certainly be done in ways that can benefit both you and the charities that you want to give to. And they can also benefit your heirs in conjunction with estate planning, as we saw with the different types of trusts that can be employed. So those can be done in ways that can actually benefit the beneficiaries that you have within your family, as well as being able to give to charities as well. But it is important to remember that charitable planning should be done in harmony with your overall financial planning, just to make sure that financial goals can be met, or actually even helped to be met by proper charitable planning that's in line with what your financial goals are. So because some of these techniques can have certain complexities, you want to remember that it's going to require getting the proper advice. That could be from financial advisors, tax advisors, and attorneys that might be employed in uses where trusts are being drafted. And a couple of resources that are nice to check if you're doing some charitable planning. The websites guidestar.org and charitynavigator.org are good website resources to look up different charities and what they do. And the IRS also provides on their website, they have a charitable organization search feature. So it's important to remember that tax deductions are only allowed for actual qualified charities. So if you have a question about a particular organization that you want to give to, and you're wondering whether it's a qualified charity that would enable you to take a tax deduction, the IRS does have that organization search feature right on their website where you can plug in the name of the organization, and if it's listed there as a qualified charity, then you can be confident that you're able to take a tax deduction for a donation to that group. So important to keep all of those things in mind with your charitable planning, and that really covers everything that we had wanted to talk about today. I'll pause here just to see if there are any questions from the group.
Hi, David. Thanks so much. Just a reminder to everybody, there is a questions taskbar here on your GoToMeeting taskbar. Please feel free to enter some of your questions here. We'll try and get to everybody's. I do have a couple to start with, though. David, the first one I have is, can you deduct the value of your time or service to a charitable organization?
Yeah, that's a popular question. Many people are very generous with their time and service to charities. But the IRS rules do not let you deduct the value of your time or service. However, expenses related to volunteering for a qualified organization can be tax deductible donations. So those tax deductible donations can include things like mileage that you drive to charitable events and volunteer opportunities, or mileage you use to bring items to a donation site. So you can either deduct the actual expenses using receipts for gas and similar costs, or you can just simply take a standard mileage deduction for helping a charity, which for 2019, that would be 14 cents per mile when you use a vehicle in service of a charitable organization. So no direct deduction for the value of your time or service, but as I mentioned, you can deduct things like mileage if you're helping a charity out.
David, the next one I have is, are contributions to a 529 plan deductible for charitable giving?
No, contributions to a 529 plan are not deductible because they're not considered contributions directly to a college or school, which would otherwise qualify for charitable deductions, because 529 plans are owned by individuals, and they have a individual as a beneficiary as well. So as such, the contributions to 529 plans are really for the benefit of a individual and therefore are not tax deductible.
David, can you please explain private versus public charities, and if you have any examples?
Yeah, so public charities would be situations where you're looking at standard ones that everybody might know of, like the Red Cross or any other local public charity that might be set up to benefit certain land trust in your area. I know in Massachusetts here, there's a couple of different land trusts that are qualified charitable groups, but certainly there's the things like the Cancer Society and the Red Cross, which would be public charities. Some private examples would be some private foundations that might be set up by an athlete or an entertainer, which are set up as charitable entities, but those are considered private foundations. So it would still be public in the sense that they're known, but they're different because they would be a private foundation set up by an individual versus a public charity.
David, for year-end giving, can you explain the timing rules of when I would need to make a donation for it to count as deductible for this year?
Yeah, that's a popular question that comes up because, as I mentioned at the beginning, many people are looking to do some donations near the end of the year. So the timing of these things is important to be aware of. So for instance, a very popular question in regard to this timing is making a charitable donation by check. So a charitable gift by check is effective when the check is delivered or mailed. So not necessarily when the charitable entity cashes the check, but you're able to use the date that you deliver it to a charity or put a check in the mail. So as long as you do that by year end, you'd be able to take a deduction for that. And cash gifts are also commonly paid by credit card, and the IRS has ruled that gifts occur when the donor becomes indebted to the credit card issuer. So what does that mean? Well, it's really when the charge is made on your card, not when the donor pays the credit card bill. So it's December 31st and you go on and you make a donation on your credit card to charity, then you can deduct that charitable donation in that year as long as you've made that charge by year end, even though your statement and your subsequent payment of that credit card bill won't come until the following tax year. So it's the timing is very important, and really similarly, a contribution to a charity by text message, which we're seeing more of that these days, is considered to be a completed donation when the text message is sent. Again, timing is important related to these, so you want to make sure that you're getting these types of donations in time if you want to get them in for this tax year.
David, just to expand here kind of on the timing, what would need to be done to start a QCD?
A QCD would be started by first contacting your financial advisor or who's ever holding your IRA and indicating that you'd like to make a QCD. And then usually, like at our firm, we have a process of going through that where we can take the deduction from the IRA and send it directly over to the charity. We have, and in many cases, there's a form for doing that. So really it's as simply as just contacting your financial advisor or whichever company is holding your IRA and just indicating that you'd like to do a qualified charitable distribution and indicate which charity that you'd like to use. So there's a couple of steps involved with it, so you want to allow enough time, but they can be done relatively quickly.
David, I think that's it for today. So thank you so much for all of this information. Just a friendly reminder to everybody, our final webinar for 2019 is actually going to be on, let's see here, Wednesday, December 18th, a little bit earlier than normal, just because of the holidays. It is on solo 401ks for the self-employed. That'll be with our senior financial advisor, Andrew Nadeau, and that is at 11 a.m. You can sign up for that on our website at stonehearthcapital.com, and you can also find the white paper that David wrote in regards to charitable planning. It goes a little bit deeper into this topic. It is available for download now. If you do have any more questions, please feel free to give our office a call. It's 978-624-3000. I know David would be happy to speak to any of you. And we hope you all have a wonderful Thanksgiving. David, again, thank you so much.
Thank you for joining us, everyone. So long.